Good morning, everybody. I'm Sarah Krom. I'm managing partner of SKC and Co CPAs, and here we are at our last office hour for 2022. I cannot believe it. Thank you for joining us. If you're like me and live in Northwest New Jersey, you've got some snow on the ground this morning, so thanks for joining us as opposed to shoveling your driveway. I do appreciate that. We won out. We have a couple of housekeeping items just to go over before we jump into our topic today. We are recording this, so if you don't want to be on video, please take yourself off video. And we will be sending out a link and it will be available on our website. So if you would like to refer a friend or a colleague who wasn't able to see it, or if you'd like to rewatch it, you will be able to do that. We will have several polling questions throughout the presentation just to kind of get a pulse of who our audience is and kind of gauge where we are on certain topics. And then finally, we want this to be as interactive and meaningful as it can be for you. So please put your questions in the chat and our fabulous Brittany will help us interject those at the appropriate moment. So for those of you that are not on the panel, if you could mute yourselves, that would be fantastic. And just communicate with us via the chat, please. All right, so let's kick this off. Let's see, it's Friday. So on Wednesday, we had the 7th rate increase at the federal funds level. We went up 0.5% as opposed to the last two, which I think were 3/4 each time. So we keep going in the wrong direction, in the upward direction. Obviously that affects lending, which is why we are here today. So we were not entirely sure where the future is going to go with this in 2023, but we do know that businesses will continue to operate, they will continue to thrive, and banks and mortgage companies will continue to lend. What that lending looks like, that's what we're kind of here to talk about today. So we have a great panel, 3 different folks, and I'm going to let them introduce themselves. And Richard, why don't we start with you?
Yes, good morning. My name is Richard Biggs, Business Relationship Officer with Kearny Bank. Been in the banking industry for about 15 years. Main focus is helping businesses from all different sizes and helping them with lending needs, relationship banking, depository relationships, being that personal relationship banker that's by your side.
And we are very happy that Richard joined us today because he does not have power where he is. So we are very tolerant of his effort to join us today and very appreciative of that. So thank you, Richard. Marc, do you want to go next?
Sure, thank you. Good morning, everybody. My name is Marc Demetriou. I'm from Guaranteed Rate. I am a residential mortgage banker and broker, licensed in all 50 states, 17.5 years of experience in this business. So I like to consider myself a mortgage expert in quotes. And I'm here to talk about some of the Fed stuff, some of the residential lending programs and guidelines and rate direction and values for homes, which we'll get into later. But good morning, everybody.
Great. Thanks, Marc. And last but not least, Melissa.
Hi, I'm Melissa Geiger. I'm with M&T Bank. I'm a relationship manager, which means I also work with all business owners and I help you with all your cash flow needs, whether it's lending or it could be treasury management, any way to get paid quicker or, pay out, get paid quicker or pay out a little bit later. So we're there for cash flow needs, and it's also a very personal service. We never want you calling an 800 number. You have my cell phone. You call me at any time.
Fantastic. Thank you. So, all right, let's kick off, guys, with our first poll. We're going to open up with the business lending side of things. So our first poll is, do you have a line of credit? Just to get an idea of what kind of business lending you guys are currently involved in. And then we'll jump into some specific business lending topics. Brittany, just a few more seconds on the poll, and then we can share the results and get a sense of where we are with our audience today. All right, so we're pretty split down the middle. So things to learn about and things to talk about. So let's discuss lending as it relates to businesses. And we know that can take many different forms, from term loans to lines of credit to traditional and non-traditional options. So I'm going to throw this to Melissa and Richard, and you guys can take turns. But what can business owners expect from their banks as far as requirements and different terms that might be available now that we're rolling into a new year?
So I guess I'll talk about line of credit first, since that was the poll question, and I saw 54% don't have it. That's a great, everyone should have a line of credit. It's an insurance policy. You only pay on what you use, and it is a variable rate. So even though the rate is high right now, when it goes down, your rate will go down. And again, it's an insurance policy. You're only paying on what you use. So if you have 100,000 line of credit, let's just use that number, and you use 5,000 of it, you're only paying on 5,000. And as soon as you pay it off, you're back to that 100, and again, I like that it's a variable rate in this economy, right now with everything on the rise. It helps with cash flow. If you want to hire people, it's a great thing to have until they're earning you money. It will help you with your cash flow needs. If you want to acquire somebody and you need the money quickly, you could do it and then term that portion out. So, because you don't want a long-term purchase on a line of credit. It's for short-term use. It's for payroll. It's for waiting for AR to come in. So it is short-term. One thing that we offer that I think is great, if it's under 100,000, we go by your FICO score. So it's a simple application. You don't have to supply anything else. And we could get you approved for 100 or less. If it's over 100, we do require 3 years business tax return, 2 years personal tax return, a personal financial statement, which we provide you to fill out. And we want interim statements for most current balance sheet and income statement. But again, I just feel everyone should have it. If you have a home and you have a home equity, I feel like that's the same thing. And Marc could probably talk more about that, but it's an insurance policy. It pays to have it.
And we always advise clients on that note, Melissa, that you want to apply for one when you don't need it.
Yeah, exactly.
Because it goes through the process a lot quicker. It's a lot less of a headache. The banks ask less questions. And then, as you said, it's there as the insurance policy. Before I move to you, Richard, Melissa, I just want to ask your thoughts on how a business owner can make the choice of what amount they want for a line of credit. Do you guys provide advice in that area, or do you have thoughts on that?
Absolutely. So we go by gross sales, and it's 10 to 15% of your gross sales. That's how we will figure out what you need. We look at your AR as well, but it's really, you could calculate it easily by 10 to 15% of your gross sales.
Okay, sounds good. Richard, anything you want to add to that line of credit topic?
Yeah, Melissa said it perfectly. I mean, all banks nowadays, we're all the same. At the end of the day, it's just, a little bit of the differences, the requirements, the terms. But like Melissa said, especially with the supply market right now, inflation, lines of credit is something that's very crucial for a lot of business owners, being able to have that working capital, because you don't know how long you're going to get paid on your receivables. So having that on hand is really going to help your business. Very similar to what Melissa said, Kearny Bank, same thing, 3 years business tax returns, personal financial statement, balance sheet. We use 75% of your receivables as well. In regards to the terms, anything under 1 million, we utilize tax returns for underwriting. From 1 million to 3.5 million, we use compiled financial statements. 3.5 million to 4.5 million, we use reviewed financial statements. And anything over 4.5 million, we do audited financial statements. So a lot of business owners tend to not want to pay the work and stuff on doing compiled. Nothing against you, Sarah, but not pay against compiled, reviewed, or audited. Where anything under 1 million, we just utilize tax returns.
Okay. And what are your thoughts, Richard, about the amount on a line of credit that a business owner should apply for?
So like Melissa said, it depends on what the net income is, what you're grossing on the business. With us using the receivables, I tend to tell business owners you want to go as much as you can on a line of credit, because, like you said, you may not need it now, but you may need it in the future. And like Melissa said as well, you pay on what you use. So if you're not using the line, it's good to have as a safety net, because you never know. Look at what happened during the pandemic. Supply chain was so delayed, and a lot of business owners didn't have working capital and had to dip into like maybe their personal funds or their business savings emergency funds. So having that line of credit on hand is very crucial.
So we've seen businesses come through COVID, some better than others. Is there any sort of lingering effects on the lending side where we should expect different terms or new covenants or stricter application processes coming out of, what may have been somewhat of a turbulent year for some businesses?
So I know with Kearny Bank, one of the covenants that we're really crucial on right now is a cleanup period. So, back in the days, or I guess maybe a couple of years, banks were a little lenient on cleanup periods. But now if, our requirement is to clean up your line of credit within 30 days, meaning paying off your balance and keeping it at zero balance for 30 days. Nowadays, if banks see that you don't clean up your line of credit within 30 days, it's almost like a red flag, at least on the Kearny Bank side. Melissa can speak more on M&T.
Yeah, we're not as strict about that with the 30-day period. I have my managed clients, I'll look at their usage. And if I see a large amount is out for a long period of time, I will call them just to make sure they're using the line correctly and just guide them. But there's no strict policy about it. The one thing that I've also just to add is when we are collecting the tax returns, we are deducting PPP money out of the sales, just for your reference, because a lot of people, add that and they think that that shows more for sales. So just to keep in mind, we do back out PPP money.
What about the employee retention credit? Do you guys reconcile for that too, or have you not gotten to that step? Because that's really on the expense side of things.
Yeah, we haven't gotten to that step.
Okay.
Agreed.
Gotcha. Richard, I do want to ask you a little bit about the SBA. And of course, that became a very popular acronym as they were the agency, who were, disseminating the EIDL money and the various different stimulus loans that came through because of COVID. So what is the role that the SBA now can play in helping business owners with their lending needs?
Oh, you have various options. I mean, look, SBA right now rates are, high, but, new businesses, any new businesses under 2 years, you still need, some type of startup loan. And that's where a 7(a) loan comes in. SBA also offers 504 loans, which 504s are, buying owner occupied properties. So as long as you occupy 51% or more, you could purchase the property without only putting down 10% rather than the 25% on a conventional commercial real estate loan. So at the end of the day, SBA is still going to be needed because, like I said, new businesses under 2 years, they're going to need that, maybe they're going to need the funds to be able to expand. And even with buying your own property, I mean, a lot of businesses don't want to pay a ton in rent. So at the end of the day, they're still going to want to have their own property to own.
One question for both of you, and I kind of get this a lot from clients who may be changing banks or going for a line of credit, and they always want to know about personal guarantees. And is there any way that they could ever get a line of credit without having to personally guarantee it? And is that something that is even possible? Is it usually a function of the size of the line? What are your thoughts on that?
I guess I'll go. So typically we do require personal guarantee. For nonprofits, we don't, which that's been coming up a lot in the credit card space. But just to talk on that, a lot of banks are requiring a personal guarantee for a credit card by the CFO and the CEO. We do not require any personal guarantee on that. And then, we did have a large law firm, again, because the partners all had less than 10% ownership. We did not personal guarantee that. So it really depends on the situation, but it's going to be one and few between.
Mm-hmm.
Yeah, I agree. It's basically the same thing. It's case by case scenario. If you have a company that's big and they're doing very well, they have a high net profit. It's very possible Kearny Bank may not require it, but for the majority part of it, yeah, we require personal guarantees as well.
Mm. So Melissa, you covered very well the line of credit, option. What do business owners have as far as wanting to buy equipment or purchase vehicles? Would you advise that they use a line of credit or a different vehicle?
No, that would be a term loan because it's going to be a long-term purchase. They're going to wind up, if they put that on their line of credit, they're going to wind up paying more on it in the long term than if they term it out. So you would want to do typically a 3-year term or a 5-year term. That is a fixed rate. So I am finding right now what's happening is because, everyone's hoping rates are going to go down. People are throwing stuff like that on their line. So you don't want to leave it on too long because again, then we're going to notice that you're not using it correctly also. So you're going to get that phone call anyway. Mm-hmm. But in the long term, even though rates are high, it still would pay to, term it out. And you're going to want to do that for an acquisition. Any acquisition funding is a term loan as well.
So what do you guys have as far as different rate options? Are the line of credit rates higher because they're variable right now than the term loans?
They are a little bit higher because prime's so high and, typically a line of credit is prime +1. is what you're going to find with most banks. Term loans, will come there. I would say they're probably in the sixes right now. But again, it pays to do it. There is a prepayment penalty on most of those, which, like, if it's a 5-year loan, at the first year it would be 5% on the balance owed. So you can bring down that balance.
Right.
And then the penalties wouldn't be that bad if you want to get out of it.
Mm-hmm. Okay.
Yeah. And with Kearny Bank, same thing. With prime being so high, I agree with Melissa. I mean, ours it can range from 0.25% to 1%. So prime plus 0.25 to 1.
Okay. We did have one question come through the chat, and that is, what does a line of credit application look like in a changeover of ownership of a corporation? So I'm going to interpret that to mean we have a change in ownership. Maybe we have an existing renewal on a line of credit, and we're changing over the ownership of a corporation. And what would that process look like?
It's similar to the original process. Like, if, let's say, a new owner is coming on with that new ownership, we're going to want to see that they could handle the loan as well, because again, they are going to become a personal guarantor. So we're going to have to see their personal tax returns for 2 years. If they've come from a different company or anything, that's going to show us, what they're bringing to the table, basically.
You mentioned earlier, Melissa, about guarantees, and that you had that law firm where there were, 10% owners here and there, so you guys didn't require a personal guarantee. We've had experiences with clients before where the bankers will actually sort of level off the personal guarantees based on the ownership of the different owners. So in other words, if it's $1 million line and you're a 20% owner, you're only guaranteeing 20% of that line. Is that still commonplace?
Like, not in this situation, that I did, and it happens to be $1 million loan, and so we did not require anyone to be a personal guarantee. Typically, they have to be over 25% to have to be a personal guarantor.
Right. Okay. Richard, anything to add to that?
Nope. I totally agree with Melissa.
Okay, great. All right. So Melissa, you started the conversation with your introduction about how you do not want people to call a 1-800 number. So that led us very well into our second poll, which is, do you have a banking relationship with one person you can call? And obviously, at SKC, we advise clients on a lot of different lending relationships and different opportunities with banks. And we sometimes get new clients that come to us and they use the bigger banks, the flashy name banks that I won't say here because I just won't. And I say, well, let's talk to your banker. Let's schedule a call. And they say, well, what do you mean? And they don't have a contact. And, to us as, their advisors, it's very difficult to, get creative with different lending options or really have a conversation and explain what a particular business's, situation might be that you can do when you have a Melissa or a Richard to call. So I'm interested in seeing these poll results and what we have on the call. All right, good. So we have a lot of people who are doing the right things and finding those personal banking relationships, because that's, very, very important from our perspective. So let's switch gears a little bit and go to some real estate lending. So we've got some record-breaking property numbers and values in the last year, maybe the last 18 months, certainly during COVID. And now we're continuing to see the rates rise. And Marc, you can speak to this a little bit, but I think we capped out a month or so ago in rates, and now we're a little bit coming down. But let's talk a little bit both on the personal residential and on the commercial side here. So Richard, I'm actually going to start with you on the commercial side. What are you seeing as far as lending for commercial investment properties?
It's tough. I mean, even banks right now, we're being very conservative on investment properties because right now, like you said, the rates are high. Values are higher than normal. It really all depends on the ROI. What are you getting out of that property? How much are the rents? Even a lot of people that own investment properties that have commercial spaces, they're looking to split the spaces down, make them smaller square footage, lower the rents on them, just because because of the pandemic, no one wants to have a large property, for a commercial spot where they don't need it with remote working now, and they just need a small space to just be able to be there for their employees. On the commercial investment, like I said, owner occupies, like I said prior, that's something that's just, it's still important. A lot of business owners are looking at that because with rental prices increasing on investment properties, why would a business owner want to pay so much of a higher rent where they could pay a little bit higher for maybe an owner occupied property and have that asset under their arm?
I was with a client yesterday and he's owner occupied and he's looking, to move out one of his tenants so he can get more space. And he's a very nice landlord. So he's actually been looking for other space that his tenant can move into. And he was just amazed at how much on the market there is office space, obviously, and he's looking for warehouse space. And the price of warehouse space is actually going up from where it used to be. Are you seeing that as well? And I mean, who's purchasing these properties now?
Yeah, I'm seeing that. I mean, warehouse spaces are going up. Businesses want to have more supplies on hand because they're, I think they're, with the pandemic and stuff like that, with them not having supplies and the supply chain being so delayed, a lot of business owners want to be, I guess, have that emergency net where they're not in this situation again in the future. I mean, I've read articles where a lot of business owners didn't want to have supplies because they didn't want their balance sheets showing, I guess, negatively. And nowadays they need the supplies because with supplies prices going up so much, and again, going on a line of credit, if they didn't have a line of credit on hand, they're dipping into emergency funds.
Are there, I mean, when we think of residential mortgages, which Marc will talk about in a minute, we think the mortgage side and we think home equity lines of credit. Is there anything on the commercial property side that is a little bit more of an option or more creative than what we think of with a building and a mortgage?
So oh, sorry, Richard, go ahead.
No, go ahead, Melissa.
I was going to say, I mean, you can't do any kind of line of credit on a commercial property. So you would have to cash out and refi it and pull money out. So that would be the only option really on a commercial property.
Yeah, I was just going to say that. I don't know. Marc might have something.
Yeah.
Well, let's pop up our third poll and let's jump into the mortgage conversation. Just out of curiosity for those on the call, the third poll is, what was the rate on the mortgage when you bought your first home? And we gave different ranges there so that, we could kind of get a sense. Of course, this will also tell us the different generations, I think, that are on the call as well. This is probably an easy one, Brittany, so we can share the results. All right. Interesting. Marc, what do you make of that? What can you tell us about our audience based on that fact?
Well, first of all, so I'm doing this almost 17 and a half years. I started back in 2005 before the financial crisis. So I got a lot of I guess tire tracks on my back from the history of this mortgage industry. But, just to touch on that, the 70s and 80s is when the rates went up into the 15, 16, 17, 18% range. Before that, they were in the 4s and 5s for years. People don't realize that. But when our parents talk about mortgage rates being so high, it was just the 70s and 80s, really. And then from that point, it dropped all the way down to 2.5%. We were like literally a year and a half ago. So just that's really the fact about where rates have been. And just to touch on where they're going, if I can go into that for a second.
Sure.
The rates were, below 3% a year ago today. So and amazingly, they went over 7% about a month ago, and you were right on the money with saying that they were lower now. But so you went from 2 3/4 on a 30-year fix, where I was locking everybody at that point, 2 3/4 to 3, let's say, and they went to over 7 literally in a year, which is just obscene. I don't know what other word to use, just crazy. So they have started to come down now the last month, and I'm not going to go into a lot of reasons why, but the main reason why is the bond market looks 8 to 12 months ahead. And the bond market and the mortgage market looks to see if inflation is getting under control, which they believe it's starting to a little bit, and the Fed's really getting ahead of it now. Our mortgage rates, the long-term rates, are starting to come down. The ARM rates and the mortgage rates, different than the prime rate, which they raised at 7.5% now to make a point where it is. So the point is real short and sweet is the mortgage rates right now. You can find 6s for 30-year fixed now. They're not really into the 5s yet. There's ARMs in the 5s. But where a lot of the smart people that I've listened to and talked to and been absorbing regularly about where the direction of rates are, a lot of economists I follow regularly, they're all believing that rates should be in the low 5s by the summer, possibly, they're saying could be spring would be really soon, but let's say summer, fall latest. And the arms will be back in the fours possibly. So I know that sounds extreme from where we are, but they dropped a point just on some good news, meaning inflation wasn't as bad or is getting more in check. To just show how much it's like a rubber band so stretched that it went from 2 3/4 to over 7, just wound up. These investors are on the sidelines, all the banks are on the sidelines waiting for things to just even out to see where the end of the top is. Now that the top's been there's a little more tension that's been released. And again, this is what they're seeing for rate wise. So that's the rate topic. I don't want to go on different tangents here, but that's specifically the rates direction.
So we had obviously, a supply and demand issue during COVID, and that, in my opinion, drove up a lot of the home values from where they, originated it maybe in early 2020. Where are we sitting now and what you're seeing with your clients as far as the value of homes and the volume of activity right now?
Yeah, so being that I'm licensed in all 50 states, I really have a great gauge on what's happening really throughout the nation. And I do follow a lot and I do loans all over the country regularly. So generally, the market's down 10 to 20% from the top, generally, depending on where you are. Some markets held up stronger, some a little bit worse. They feel that there's another 10% possibly downside from here, worst case. The reason why it's not going to drop down like it did in 08 with the financial crisis, for many reasons why, is there's very little supply. There's still very limited inventory in this marketplace, mainly because back in 08, there was so much overdevelopment. So for 3 years, they didn't develop. They didn't build any new stuff. They were just finishing up all the stuff that was like half done and went bankrupt, and builders came in and finished things up. They're supposed to build so much per year to bring inventory into the marketplace. So we never caught up from that, number one. And number two, with the COVID backlog for no one doing anything for a year, and then doubling up and tripling up all the moving and relocation, everyone jumping in the market, and even buying investment properties was a big thing. It gobbled up so much inventory. There's lack of inventory. And honestly, demand's going to outpace inventory for a very long time from here. This is the reason why buyers on the sidelines tell me, "Oh, I'm going to wait it out." Like, listen, the next 2 months are the best time to buy right now for a long time. Even though rates are higher, we can refinance in a year. That's fine, but at least you'll get a better value when you purchase. So the fact is, everyone that's on the sidelines waiting. Different than 08 where they just got out of the market. They just couldn't get a mortgage. Now it's just waiting. And when they go back in again, when they go back in the market in the spring, again, it's going to be limited inventory, a little more bidding wars, a lot more activity. So it's just, people got to understand that's what's going on right now.
In the last couple of months, what are you seeing as far as activity? I mean, is it a lot of second homes being purchased? Is it relocations? Is it downsizing? Is it a combination of all those things? What's typically the driver here?
So refinancing is off 90% from last year, just to put it into the extreme nature where we are. 80% of the country refinanced in 2020 and 21 into 2s and 3s. So the only refinance I'm doing is divorce lending. People are getting divorced. Estate planning buyouts. People that are pulling money out to buy something else, cash, second home or investment, to build something in another state. People that just have to do debt consolidation because they just have no choice. They're out of control with their expenses and payments. That's the refi side. On the purchase side, really, again, is if you have to buy right now, you're buying. If you're smart and realize it's the best time to put in a lot of offers and see what you can grab, then you're buying. But there's a lot of people on the sidelines that aren't properly informed like this, realize it's a good time to buy if you want to buy. So the activity's down big time. Purchases are down 50% from last year. A couple of things too, the investors, a lot of the hedge funds about 4 months ago stopped, literally that whole space stopped buying investment properties. They realized what was going on, maybe even 6 to 4 months ago. So hedge funds have stopped coming and buying. A lot of investors have slowed down the buying flips. And also the overseas people have stopped buying here too. So that whole investment space, Airbnb, let me buy it, Airbnb it, let me buy second homes, big, huge slowdown there. The Airbnb market's been getting killed because, again, people overbought. Let's buy Airbnbs, we'll rent them out. That whole space is getting destroyed right now. Also, people that were in that space buying. So it's really back down right now to people that are going to buy purchasing of homes, primary residence, and some second homes, dabbling in the investment space. But, we're off 50% from last year. Things will start to normalize. I really believe that February, March, we'll get a real good look at where we are. I think with all these raising of the prime rates, inflation will start, inflation numbers will start to come in pretty tame. I think the stock market's going to have a little bit of interesting times with the earnings of companies this first quarter, and second, from all the really from all the downsizing of companies and limiting their sales, limiting their activity, just trying to get mean and lean. But that's what's going to happen. And you'll get a good gauge by Fed March on where we're going to go with housing and rates.
So your perspective, well, let's give a little perspective, right? So you're saying that we're down 50% from where we were last year, right? As far as purchases.
Yeah.
But weren't we kind of at an all-time high a year ago?
Yeah.
So we were way up
insanity.
here and we're down from that. Okay.
Yeah. So insanity. So I'll put it in perspective too. So yeah, it was definitely not a normal year. So we're getting back to like 2019 years, right? Which is somewhat normal, right? We're normalizing. So the fact is that the business itself, like I'll tell you, as a whole in our industry, most mortgage companies and banks are off like 60 to 70%. I'm not kidding, from the volume of last year to now. That's to show how extreme the drop off was. But those 2 years were 4 times the normal volume each year. Okay, so do the numbers in your head about how that plays out percentage wise. So we're definitely normalizing, right? But I think with the refi, usually 40, 50% of the mortgage activity in this country is refinancing too. Well, that's off 90%. So that's where it's going to be a very big, slow moving volume pace, because refinancing really is going to be a matter of once the rates come back down to the 5s or 4s, then it can start to make sense for people to refi at the 3%, pay off that high HELOC rate and some debt, and then get down maybe to a 4% even rate and be happy with it. That's when it's going to start to happen, because the prime rate is going to take a couple of years for Feds to lower that again. But the mortgage rate is going to come down a lot sooner. So if you have this high prime rate on the HELOC, people have been tapping in, paying debt, surviving through this economy, and you have a 3% mortgage at a couple $100,000 or 400 or 500 in a HELOC with that same thing at 7, 8%, 6.5%, you'll start to see more refinancing in the next year because of that too.
So your perspective is by spring, maybe summer, we're going to see rates in the 5. Is that?
Yeah, I think by the summer to fall, the latest, low 5s on the 30-year. If we're lucky, high 4s, which means the R rates will be in the 4s, maybe 3s. That's what they're expecting to happen at that point. Could be between May and September. It's hard to say exactly when.
So Richard and Melissa, I'm going to ask you guys your perspective on this from the business lending side. I know it doesn't necessarily always, correlate with the mortgages, but do you guys expect to see rates come down in that same time frame on the business lending side?
We're saying late spring, early summer. Yes. Yeah.
Yeah, I agree. I think the rates are going to go down. I mean, if Fed increases rates still, I mean, there's so much that the banks could go down, but like I said, like Marc said, with the mortgage rates, they went down a little bit. I think for banks to even stay relevant and people to actually still buy investment properties, we're going to have to be competitive on the rate market. I mean, banks right now are just, let's say, struggling, but it's such a competitive market on, just lending rates, depository rates. Everyone's just fetching around everywhere. And, like I said, I could see the rates going down.
So Marc, you mentioned that you advise people if they can put offers in, get things going now as opposed to February, March timeframe. Melissa and Richard, do you guys advise business owners if you're waiting on a big purchase, if you're going to look for a term loan, should they wait a few months and kind of, I hope it's not a strategy, but kind of plan on the rates going down a little bit, or what are your, from a strategy and a business operation standpoint, what are you suggesting?
Honestly, I think, and what I think we're seeing in the lending, area is if they need it now, do it now. Like I recently had a customer that needs to buy 2 18-wheelers that are going to be 1.2 million. He can't wait, so we have to figure out the best structure, so I think if it's a truly needed, piece of equipment or an acquisition or a property that's going to help your business in the long run, that's how you have to think about it.
Yeah, I agree. Look, business has to go on. I mean, if they need an equipment, definitely, I still see business owners looking for term loans. Going back to line of credits, I think that's just crucial for everyone. If you can get a line of credit, take out a line of credit right now. Investment properties, that did slow down a lot. And banks are even a lot more conservative in regards to that. But like I said, if the ROI is there and you're seeing the rental incomes increased on that investment property, and like Marc said, and maybe in the next year, we're going to see rates going down, you're going to start seeing a lot of refinances.
Right. Marc, let's go back to you on the residential side. And you gave some great examples of, why people need to do things now, whether it's a divorce or estate planning or things like that. So what are some options that buyers have if they need to do something now, again, with either a purchase or a refinance?
Different lending options in general.
Mm-hmm.
Yeah, so I'll since there's a lot more business people on this call, I'll touch on some really, really great products that are outside the box, which Melissa and Richard will appreciate. So, you have your general traditional 2-year tax returns, is what every bank wants to see when you're doing mortgage, right? So we have some, here at Guarantee Rate, we're mortgage bankers and brokers, so we have a lot of niche portfolio products too. So basically, if a borrower can't show a lot of income on the tax return because just the way that the money comes in and goes out, we can do a 12-month business bank statement loan. We'll look at 12 months of their business bank statement. We'll take their gross deposits and divide by 2, and we'll use that as their income to qualify for loan without getting their tax returns. So fantastic product for people in the business space that, again, just don't show a lot of their tax returns. That's product number one. That's amazing.
How new is that?
Say it again?
How new is that?
We've had it it's been around for a year or so, a couple of years and here or there. Definitely is more prevalent now.
Yeah.
Get people, the banks start to get a little more creative with these portfolio banks when they want to lend. There's not a lot of traditional lending going on. And I think with COVID, there's 2 other products. With COVID, that's a great product with COVID too, because people may have had really bad 20s, and a lot of them had really bad 20s, and kind of okay 21s, and 22 should be better, hopefully. So that helped a lot of those people. Secondarily, if people have a lot of assets, non-real estate assets, so investable assets or retirement assets or savings, we could use the assets as a factored number. So we don't collateralize or liquidate the assets like all these big brokerage houses do. We'll basically look at the asset, use their age, and we come up with a factor number to say, based on your assets, we'll give you this much credit towards income, towards qualifying for loan. Again, not needing their tax returns, but if they have some income, we can use that to support the additional income we came up from the assets. Again, another great product. People have a lot of money, we just don't show a lot of tax returns.
So when you say assets, would that be retirement funds? Would that be, okay.
Yes, so every non-real estate assets, so retirement, and all investable assets. Invest in stocks, bonds, mutual funds, savings, checking, sometimes cash value life insurance. So those are assets they'll use to qualify for income. Another great product. A third one is we'll use only if they've been employed for 5 years, had a business for 5 years or longer. We'll use just 1 year tax return to qualify them for a loan. Again, this helped dramatically with 20 being such a bad year for COVID. When I had that 21-year return, it was great because I didn't have to get 20. It really helped a lot of people in the situation. We need the P&L for 22 to show they're doing okay. That helped a lot of clients as well. So these are some, and I have other programs like, someone that's a Schedule C borrower. We'll take just the 1099s only. We'll have to worry about the Schedule C or their tax return themselves to see what kind of business they have coming in. Helps a lot of real estate agents, a lot of insurance agents. So there's a lot of creative products without going on a tangent. But this is all to help the self-employed business owner side of the equation.
And what are some of the different lending options requiring as far as down payments and percent of equity to the value of the loan?
Yeah, so VA is 100%. We're actually a USO partner. We do a lot of work with the VA. I personally am a VA loan expert. So I do a lot of loan with VA, 100% financing with VA. We have a lot of doctor loans that are 100% financing as well, very limited down. There's great doctor loans out there for people that just get out of school and don't have a lot of money yet. The banking world believes in doctors, so that's a great product as well. We have, your traditional 3% down non-FHA loan, which is a great first-time home buyer. They haven't owned a home in 3 years, where it has to be 5% down non-FHA. And FHA is 3.5% down. And most people know FHA is more towards people with lower income, lower credit scores, some blemishes on there. That's the FHA product. That's 3.5% down. So there's still lots of options out there. I can do jumbo loans at 10% down, which is still great because usually in jumbo space, there's no mortgage insurance lenders that do the jumbo loans. We still have options for 10% down in jumbo space. So that's just give you an idea with some of the lending options.
What's considered jumbo? Over 650? Over
now it's over $1 million. I mean,
okay.
The break was crazy. The break point for 2023. I just got the numbers. So Fannie Mae, just real quick on that. So there's the conventional conforming limit, which I think is like 8 something now in most of the country. Then they have this, it's called a high balance limit. When the financial crisis kicked in, the jumbo market just collapsed. There was no one doing loans at all. So Fannie came in and said, we're going to temporarily, in quotes, increase our limit, called a high balance limit, up to a certain amount in high cost areas like New York, New Jersey, Connecticut, throughout the higher valued areas in the country. So they bought this higher limit. Well, they never stopped doing that. They still do it. So they have the regular conforming limit, and in high cost areas throughout the country, they have this high balance limit, which again is up to $1 million. That's insane. So the real true jumbo limit, most of the high cost areas is over $1 million now. So
Wow.
and it's just real pretty extreme. So
Are you seeing a lot of mortgage insurance still as a thing nowadays, or is there less and less of that?
yeah, listen, if you can't put down 20, think about it. When I do the numbers with people too, you can't put down 20%. The mortgage insurance isn't thousands of dollars a month. It could be hundreds of dollars a month. So if you want to preserve capital, and when I'm, and you know this too, working these for years, when I'm speaking with a client, it's all about the financial package of that client, about the mortgage rate or term, or, I really dig in first about what are you looking to do? What are you looking to accomplish? How much money you have in reserve after we buy this house? Especially with divorcing cases, they sometimes want to keep the payment as low as possible and use all their money. And I advise otherwise, is if you want to keep the reserves, keep the cash in the account, make an imaginable payment, don't use all your money. So there's ways to do that. So it depends on each situation. The point is, if you're putting down less than 20%, the mortgage insurance is not that expensive. If you can preserve, 20, 30, 40, $100,000 in your account and spend $100 on mortgage insurance, that will eventually go away once you're at 80%, 20% equity. That's a better way to go. So it's all about the equation, and rates aren't necessarily higher because you did mortgage insurance either. So it's definitely a good helping situation for borrowers when they're in need of doing it, or giving me an option to look at what makes the most sense for them.
And that's another very key point that we talked about with Melissa and Richard, which is you want to have a mortgage person that you can have a relationship with, right? Mm-hmm. So you can have those kind of conversations, and they're not going to cookie cutter stamp, your loan. And it's a deep dive into what works best for you. What's the best payment structure? How much do you want to preserve in your account? Relationships.
Right.
So I'm going to start with you on this, Marc, but I do want Melissa and Rich's opinion on it as well. And this is something that we recommend to our clients, and sometimes it throws some of the lending curveballs in it. And that's about buying residential property in an LLC. In most of our scenarios, it's clients buying, residential property because they want to turn it around and make it a rental, or it's a vacation home and a rental. And for a lot of different reasons, we advise that to be done in an LLC. But, how is that different from just a human borrowing a mortgage?
Yeah, so basically, I think 99% of all residential lending banks or lenders, they won't do title and LLCs for borrowers because it's really considered more of a commercial loan. And I want to say it protects the borrower, not the bank, because if you have an LLC on title, it's just another layer for the bank to foreclose on someone's house and get to them. That's why a lot of banks don't like it. It's more on the commercial side. And commercial loans are very different for foreclosing than it is on residential, especially in Jersey. So the good news is, as a residential mortgage lender, I have options to do LLCs and trusts, revocable or irrevocable, which is unheard of, for primary residence, second home, and investment property. So again, I'm that advisor, like you talk about all the time, to have options for borrowers, which makes the most sense for them, not a cookie cutter. Here's what we have. So it's good to have the outside the box options. And a lot of bankers or people in general are very enthralled to know I have those options to help their clients. A lot of banks, commercial banks, individuals out there, knowing I have this product, they are very pleased, and it helps me to bring in business because I can do things like that to help clients. So yeah, it's a great product, but generally it's mostly for investment, some second home, and very few primaries ever you'll see out there with that.
Melissa, Richard, thoughts on that?
Yeah, I mean, Marc, that's a great product. I mean, Kearny Bank, we do 1 to 4 families on LLC, but maybe one property. So if you have another, you have a person that has numerous investment properties, we wouldn't put them all in LLCs. So I mean, it's a great product that Marc is offering. When it comes to rates on an individual, residential mortgage rates are a lot less than commercial real estate. So like Kearny Bank, we're not touching anything that's maybe less than 10 units. We're looking more for like multi-units, bigger properties, probably minimum threshold of like 2 million or higher. So when it comes to someone that has 1 to 4, 1 to 4 units, Marc is definitely the guy. I mean, he's able to put that, or an LLC into a residential rate. I mean, you can't beat that.
Melissa, any differing thoughts there?
We will do your 1 to 4 family, but I actually just gave Marc a referral, which he's doing fabulous with, just a shout out to Marc, because it was a person, primary residence that was bought under an LLC, which we really wouldn't do, but we do the 1 to 4 family homes if it's, investment.
Yeah, and we do. I have clients that come to us and they've bought something and it was much easier for them to close on a mortgage in their own name. And then they say, well, I'll just transfer it to the LLC. And I was like, well, that's not really how it works. Is there anything that, any of the three of you want to comment on that, just from a buying it personally and then transferring it? It doesn't really work. So I usually don't find out about it until after the fact.
Yeah, I always tell people to buy it in the LLC. And if they're not planning on transferring it, that's a different story. But if they are planning on transferring, it's just, you really want to make sure you're doing, opening it properly. And it's for their own protection. So, and that's how I explain it.
Yeah, and on the legal side, literally, the mortgage documents do clearly state in there. Again, it's 80 pages, people don't read everything. But when I hear someone tell me that right away, that's like someone saying, I'm going to buy a private residence, but I'm really going to rent it out. Like, well, I'm not happy I heard that, and it's called fraud. So let's start the conversation where I can't do that for you. I'm sorry. So basically with the LLC, I tell them the paperwork says literally that if you change the title in here, that the bank can call the loan. It says it in there, and they can. Did they ever find out? No. Does the town report to the lender when the title's changed? No. And they really should. I'm so surprised they don't do that. If the title's changed, they should automatically have to report to the lender. No different than the homeowner's insurance isn't paid or it's terminated. They let the lender know about that. But anyway, that the loan get called. Does it usually happen? No. But basically, and there's even a look back period. So people do make that change if something happened liability wise, they're still on the hook. They think they're, I changed it to an LLC, I'm protected. So it really is better, do it the right way from the beginning. If the purpose is to protect themselves, and just to do it the right way. But, a lot of situations they don't really understand that they can and can't do, but that's really the facts of the matter with how that works.
Great, terrific. Well, I don't expect any of us to have a crystal ball, but I do want to do a quick round robin of the three of you. And Marc, we can start with you. What do you think for 2023? And even if you want to go as boldly into 2024, on your side with the real estate and the mortgages.
So I'm going to start. 24 is going to be a great year. Very confident we'll be into a great year for 24. 23 will be an interesting year to see how it plays out with rates. The prime rate, and which ties into, a lot of the commercial lending, basically the structure of how they do it, business loans, car loans, credit cards, student loans. That whole space in that world is what the feds have been raising the rates on, right? The Fed's fund rate, which is the rate that banks borrow from the feds, used to be 0 to 0.25%. It's now 4 to 4 1/4. It's actually 4.5 to 4 3/4 now with the last raise. Just to show how extreme of the nature of it was so cheap for banks to borrow money and lend it out. Now it's very expensive. And knowing rates are going to come down, they're reluctant to borrow from the feds. So now relying on deposits to come in. So little tangent there, but that's that. I truly believe the prime rate, the feds have said it, don't expect us to lower these rates anytime soon. Everyone's just saying, they'll come back down. So I think that prime rate is going to sit around probably 8% by the time they're done, maybe 8.25%. So all this stuff, if they want to cause pain, they've said it. We want to slow down the economy, not temporarily, but really get it to a point we're comfortable with. So they're going to really be killing that commercial, not killing, but hurting the space in the commercial space, business loans, student loans, anything, HELOCs, that whole space to keep everything where it slows down, right? But the good thing is the companies have cut costs, cut expenses, cut people, mean and lean, right? So when the economy starts to turn, which I think it'll start to happen by, third, fourth quarter, definitely fourth quarter. I don't think we're going to go into a heavy recession. The companies will be so tight and mean that when this sales start picking up again, you're going to see great profitability. So the next 2 quarters may be a little tougher for the Wall Street earnings, but I think when the business comes back, it comes back really strong. I saw that happen in many years of doing this in my 17 years. So that's on the business side. I think mortgage rates, like I said before, I think we'll see that happen and that come down a lot sooner than the other rates, which I think, again, will be in the low 5s, the 30-year high 4s, which mean ours being the 4s, maybe 3s. So I think, business will start picking up by February, March, because we'll get a handle on the feds. We're done raising rates. We've caused some pain. Let's see how this trickles out now. I think the fear and the scare of the Fed's never stopping is what's everyone's in their heads. Once the Feds say we're done now, let's see what happens. I think the economy and investors and people in general like that.
So you're not predicting a hard landing?
I don't think we're going to have a hard landing. No, not near. I lived through 08. There's a lot of reasons why we had a crash there. This will not be a hard landing.
Okay.
I think that, yeah.
Richard, how about you?
And I think Marc touched on every single part of that. I mean, I agree. I think 24 is going to be a great year. I think beginning of 23 is going to be a little tough. I think banks right now are, with the interest rates going higher, we need to keep higher reserves. We need deposits to be able to do lending. So, I mean, the first couple of months is going to be interesting. I think business owners, when it comes to line of credits, owner-occupied properties, we're still going to see that coming into the bank. I mean, everyone's going to need that. Like you said, if a business owner is looking to expand and need more space, then they're going to go into an owner-occupied property. Investment properties in the first 3 months, I mean, on the bank's side of it, it's going to be a little tricky. I mean, it's going to be on a one-off scenario if this makes business sense for the bank. But anything in regards to like term loans, lines of credits, owner-occupied in properties, banks are still going to look into it, even though if the rates are higher. I mean, like I said, in a couple of years, hopefully in 24 or end of 23, if rates go down, you're going to be able to refinance it. So,
Melissa, anything to add? It's
Not
tough
much.
to go last, I know.
Yeah, Richard and Marc really summed it up. The only thing, I'll agree with, Richard and Marc. If you're really, again, I'm going to say, if you want to acquire business, people are still moving forward with acquisitions. People are still looking to grow their business. Like Marc stated, lean and mean, that's another great reason to have that line of credit in place, because when it does pick up again, they're going to need to hire.
mm-hmm.
So again, just be ready for it to pick back up, set yourself up, for success. Just pivot with the times right now.
So we all have to hold on till 2024 then, huh? The one thing I didn't touch on, and I should have brought this up when we were kind of talking about the residential lending, is we didn't, and this applies to all three of you, we didn't say anything about construction loans. So I'll open it, Melissa, we can start with you on the commercial side. Mm-hmm. If you, the three of you have any thoughts on construction loans.
Yeah, I mean, it's the same as everything else. If we're doing them, it has to be a strong, situation where, the bank has to make sure that it's, good for them as well. But we are moving forward with construction loans.
Yeah. So for Kearny Bank, we do construction loan only on commercial properties, not on residential. But same thing. I mean, we'll look at all the financials, and if it makes sense, I mean, we're going to move forward with it. I mean, the one thing with Kearny, and I'm sure M&T is the same, and Marc, we're not here to waste your time. So we're not going to be, taking documentations and keep on wasting. We're either going to give you a yes or no, and we're going to be very honest with it.
Yep.
And Marc, how does the construction loan work on the residential side?
Well, I'll tell you the easiest way is first, when they call about a construction loan, the first thing I tell them is we have any holes we can pull equity out of instead of doing a construction loan, because the costs are higher, the draws, the rate, the fee. I mean, everything about a construction loan is just the risk of it. The bank's a little skittish on it, so it's all about, can we take money out of any of our houses? I've done a lot of that, and that's where we're refinancing houses, or a couple of them. As far as a construction loan, it's far and few between. I mean, right now, depending what they're looking to build, the appetite for some banks with construction loans, it's a different process. There's limited. The banks are in a situation where they have to give a lot of money on savings rate to bring in money. There's not a huge spread between what they can lend out to stay competitive. So they're having to be competitive on the savings rate side to compete. And then they're still going to make money by lending out. It's not a huge spread. So it's like, they're very, very particular where they want to lend. I know there's some banks that are like, all right, the residential mortgage department have this much to lend out, and the commercial mortgage department, this much less, and business department this much. So they're very specific when that needs to get done. There's still construction lending options. I think it's, the appetite of a lot of banks in general are just, watching them very carefully and just really want the best of the best clients for those. And that's the riskiest of all, construction lending, then investment lending, then second home and primary. So, there's still options for us out there, but definitely much more expensive.
And Marc, you raised a very good counterpoint. We were obviously talking all morning about lending and rates on the loan side of things. But Melissa and Richard, what are you guys seeing on your banks from, any kind of savings rates? I know most business operating checking accounts are no rates at all, but do you guys have any interesting savings vehicles or anything open for business owners to, if they have some extra cash that they want it to keep it somewhat liquid, that you guys can offer?
Yes. So we're doing, and it's been taking off hugely. It's been my biggest product is the sweep account. So that's earning like 3.25 right now. So let's just say you have an excess of 300,000 that you could sweep at night. It goes into the market. It comes back the next morning. And you pick the amount that you want. But like right now, I just quoted someone just to kind of put figures in there. On a 300 sweep, there is a $200 monthly fee, but they're still making out with, I think it was $1,000 a month in interest.
So with Kearny Bank, like Marc said, we need deposits to be able to lend to different vehicles. We have a sweep account, but the sweep account, the purpose is for FDIC insurance. So we provide $30 million in FDIC insurance for business owners, individuals. That's paying around 2.8%. Then we have a regular money market paying at 3%. On the operating side of it, we have earnings credits. So any businesses that's looking for RDC services, ACH originations, online wire transfers, we provide a 1% earnings credits to offset fees. So which essentially means less money that you would have to keep into a non-interest bearing account and be able to put more into a money market to capitalize on your funds.
Gotcha. Great. All right. So ending on a high note, then, I like that. Any final thoughts from any of the three of you fantastic panelists today before we close out as we approach the top of the hour?
I'll just touch. I mean, just in my space, the residential mortgage space, as I tell all the advisors I work with in the business is don't ever tell your client no, or anyone on this call. Don't ever tell them I don't think you get a mortgage. I don't know if that's going to work. Your credit score is 580. Like, just send them to the mortgage expert, Marc, let me figure it out. And if I say no or can't get done, no one's going to do it. I'll tell you when they can and why they can or how it'll get done. So that's the only advice I would say to the group is a lot of different options people aren't aware of. So that's how I'll leave off on my note.
And look, we touched on it before, relationship banking, relationships in general, myself, Melissa, Marc, we're here to help business owners, individuals with the knowledge in general, being there with you every step of the way, not being able to have to call 1-800 number. Like Melissa said, business owners have my cell phone. They text me. I mean, I have personal work-life balance, I understand, but there's always time to shoot a text at 10 o'clock at night if a business owner needs help. My motto is I treat business owners on how I want to be treated. I'm going to do business with someone that I can reach out to, that I can be there with that, be there with every step of the way. And I think it's crucial. It's crucial in this type of market when it comes to lending, when it comes to depository relationships. PPP was a prime example. A lot of business owners didn't have the knowledge. They had CP firms like SKC. They had bankers. Some bigger banks really dropped the ball. So, having someone by your side, especially on a banker, to make your life a lot easier so that you can run your business, that's what we're here for.
And I'll just add, going back to the relationship, you don't have to be a customer. Reach out anytime. We love to act as a resource as well. Any questions you could bounce off us that could be helpful, we're here anytime.
Great, great. Well, thank you to our audience for joining today. And Marc, Richard, and Melissa, thank you for being our very knowledgeable panelists and great relationship folks yourself. I want you all to have a wonderful, happy, and safe holiday. And if anybody on this call has any ideas for topics that you want to hear on office hours in 2023, please email Brittany. We want to keep this as relevant and as meaningful to you as possible. And we wish everybody a very, very happy new year, and we will see you next year. Thank you guys so much. Have a great rest of your Friday.